Hi, good morning. I'd like to welcome everyone to the latest installment in our Economic Advisory Series. In partnership with our friends at the Global Business Alliance, we're thrilled to host and highlight our shared member institutions as they drill down into the economic issues facing our country. We're fortunate to have vast knowledge and expertise within our memberships, and we want to share that with lawmakers and others shaping public policy conversations in Washington and around the country. For those of you I have not yet had the pleasure to meet, I'm Beth Zork, CEO of the Institute of International Bankers. We represent internationally headquartered banks from more than 35 countries that operate in the United States. Our membership includes banks of all sizes, portfolios, geographic reach, and clientele. Our mission is to ensure that the U.S. banking laws and regulations are applied fairly to internationally headquartered banks so that our members can compete on a level playing field with domestically headquartered banks. This is critically important because our members inject billions of dollars each year into state and local economies across the country through direct employment, capital expenditures, and other investments. I'd now like to turn the virtual floor over to Nancy McClernand, President and CEO of the Global Business Alliance.
Hey, Beth, great to see you, and congratulations on joining a terrific organization. We're so pleased to be doing this with you. As Beth mentioned, I am Nancy McClernand, and I am President and CEO of the Global Business Alliance. For those of you who are not already familiar with our organization, GBA represents nearly 200 international companies doing business in the United States across a wide variety of industries. Our member companies are foreign, but they are also American, being in this country for decades, some for more than a century. These companies were founded abroad, but they have made a deliberate decision to invest in the United States and employ Americans. All of our members are globally headquartered in countries that are friends and allies of the United States, 22 different countries in all, but all friends and allies of the United States. We represent every facet of the U.S. economy, autos, insurance, chocolate, semiconductors, chemicals and pharmaceuticals, just to name a few. Our members operate in every congressional district across the country. Overall, nearly 8 million Americans get a paycheck from international companies. These employees earn an average of $85,000 a year in compensation, which is 10% higher than the overall economy average. So this is our third year partnering with the IIB on the Economic Advisory Council. Our goal is to highlight some of the world's leading economists and their research from international financial institutions who have a presence here in the United States in order to provide policymakers and the media and all of you tuning in today with sort of unvarnished insights into the complex economic issues facing our country. And every time we seem to hold one of these, we hold them quarterly, there is definitely some critical economic developments to discuss. In a minute, you're going to hear from Tom Joyce, who is Managing Director at MUFG, who will cover the top 10 themes he sees that are driving the global economy, policy, and markets in 2023. But first, I'm happy to turn it over to Roger Hollingsworth, who is the head of U.S. Government Affairs at MUFG Bank. Good morning, Roger.
Hey, Nancy, thank you. And thank you, Beth. And also, I'd like to offer my congratulations on you're taking over an extraordinary group in IIB. Both GBA and IIB have been and are extraordinary stewards for financial institutions. GBA certainly on behalf of foreign entities with significant presence in the U.S. And so certainly thrilled to join you all for today's economic advisory session. I'm Roger Hollingsworth, Managing Director and Head of Government Affairs for MUFG. We're thrilled to have, and I'm thrilled to introduce Tom Joyce, our Global Head of Investment Banking, Capital Market Strategy for today's session. For what I'm sure you'll find to be a timely, informative, and engaging dialogue. Before I turn it over to Tom, I thought I'd take an opportunity to tell you a little bit about MUFG Americas and MUFG Bank, our Tokyo-based parent company. If you don't account for the Chinese national banks, MUFG is among the top 3 largest banks in the world. We operate in over 40 countries around the globe. We employ well over 100,000 individuals. people globally, and we have in excess of 3.2 trillion in assets. We're deeply committed as a company to the U.S. market, and most recently divested the Union Bank retail franchise, which we sold to U.S. Bank. And so MUFG is undergoing, as our CEO, Kevin Cronin, recently noted, a pretty meaningful transition. But that transition is going to allow us to remain deeply committed to the U.S. market and focus in our preeminent position in corporate and investment banking, and in particular, project finance, where we are project lead in a wide array of areas, including infrastructure, energy, and sustainable finance. Many of you likely never heard of MUFG. The result of our size and scale of our investments and our reach to customers and clients in the U.S. and around the globe, however, ensures that we are likely invested in parts of the country where many of you, particularly for our Hill staff, have members in your districts and in your states. We are proud to be invested in and support businesses, economic growth, and job creation all across America. It goes without saying that these are interesting times. And as the Chinese proverb says, may you live in interesting times. And these certainly are. As someone who worked in and around Capitol Hill during the last financial crisis, I'm comfortable saying that the good news is eventually we'll find our way through it. Our markets, our financial sector, and our institutions prove themselves resilient, and the U.S. will continue to remain the heart of global capital formation and capital allocation. In that regard, I'm proud to say that MUFG is a source of strength in the financial system, both in terms of safety and soundness, and in terms of financial stability. We are today as we were in 2008, when this institution helped provide an infusion of capital that enabled Morgan Stanley to continue during a pretty challenging period, like many other venerable U.S. institutions faced at that time. So against that backdrop, I am very proud and happy to introduce Tom Joyce. I hope you all enjoy the presentation.
Okay, thank you, Roger. Thank you to everybody for joining us this morning. Before I ask the deck to be loaded full screen, let me just make a couple of additional intro comments so you have perspective on the kind of work that I do with corporate America. So as Roger mentioned, we are a top 3 bank in the world in terms of size outside of China. I spend about 90% of my time with large cap U.S. companies, big names across every major industry, names like Disney and Nike and Apple and Coca-Cola and Caterpillar. Spend time with boards, CEOs, CFOs, and treasury teams, advising on our views on what's happening in the global economy, global policy, and global markets. We are very much markets focused. I've been on Wall Street for 27 years. I've been in this role for over 15 years. So I was doing this during the financial crisis. I have, I think, good perspective on what's going on in the banking system and markets, and I'll touch on that today. But we also in this role take a very global perspective, and I'd like to share that global perspective with you today. In this role, I've probably traveled to about 20 countries over the last year. I'll be heading to Hong Kong tomorrow for a week of meetings in Hong Kong and South Korea. So we also speak to global multinational corporations around the world. We do monthly publications. We released one yesterday on the Fed, one actually a week before that on Silicon Valley Bank. And what I'd like to share with you this afternoon over the next 30 minutes, and if we could load the deck to full screen, we'll get started here, is our thoughts around this very complicated global market and global economy over the next year. Now, you notice here that we call this the new macro supercycle. I want to talk not only about what we think about 2023, but I want to look beyond 2023 on a multi-year basis, recognizing that it's a low visibility environment. I like to start this presentation, of course, with a Lenin quote, not entirely appropriate for the capitalist system we're going to be talking about today. But I was really struck by this quote, and I think it speaks to where we are today. When I first read this a few months ago, there are decades where nothing happens, and there are weeks where decades happen. And that's really fundamental to our thesis, this new macro supercycle thesis. If you think about the last 2 to 3 years, largest epidemic in a century, largest land war in Europe in 70 years, highest inflation and fastest Fed tightening cycle in 40 years, and then obviously the events of just the last couple of weeks. It's hard to imagine that markets and the economy perform and trade over the next 2 to 3 years in a manner similar to the decade before COVID. We think we're in a fundamentally new environment post-COVID, post-Russia-Ukraine, post-Fed tightening. Much of this has been building for many years, but a lot of it having accelerated in the last few years. Visibility in this environment is low. Visibility is low. We were not even contemplating Silicon Valley Bank as recently as a month ago. Visibility in this environment is low. But by speaking to these frameworks, I think that while we don't know exactly where the markets and the economy and the banking system are going to go over the next 1 to 5 years, I think that using frameworks, structural frameworks such as these, I should say, help us to sort of narrow the lanes in which things play out. And let me start with theme number 1, this idea that we're seeing, that we have been witnessing over recent months, that our financial system, as it has been built over the last post-financial crisis decade, and it is a much, much stronger system than it was prior to the financial crisis, but it certainly appears to be a system that is struggling and perhaps intolerant of higher interest rates. The backdrop for this, of course, is, as you know, we have had more than a decade pre-COVID of extraordinary monetary easing, not just the Fed, but many other central banks. Nearly a decade of zero interest rate policy in the United States, Europe's grand experiment with negative interest rates for much of that 10-year period, which began with Denmark in 2012. And your big 4 central banks, as you see on the left side of this page here, increasing the size of their balance sheets by a multiple of 5 times, from 5 to 25 trillion. A decade of extraordinary monetary easing. And we would say, from a market perspective, arguably too much fiscal stimulus. When you combine a decade of extraordinary monetary easing and a significant amount of fiscal stimulus, and we recognize that a lot of this stimulus was needed for Americans during the COVID period. But it's really hard to fine-tune the amount of stimulus that you need. And certainly at least some portion of the inflation environment that we are dealing with and the decade plus of low interest rates is a function, a side effect of this extraordinary monetary and fiscal stimulus. And then if you sort of take a step back over a 40-year period and look at our relationship with China and our relationship with the rest of the world, the manner in which we have restructured this U.S. economy to become largely a services-based economy. And there are a lot of very positive benefits that have served the United States very well through this system. But today, compared to decades ago, we now have an economy that is nearly 80% services. And within services, the financial sector is the largest subsector of GDP. So after a decade of extraordinary monetary and fiscal easing and multiple decades of building a very strong, large, but arguably outsized financial system, you can see why, where we are today, that we have a system today that is struggling with higher rates. We are not saying we are opposed to rates being increased. They need to be increased to address inflation. What I'm trying to say is that the financial system globally, not just in the US, has struggled with the pivot, the rapid pivot over the last year toward higher rates. We first saw the accidents begin to happen in the UK back in September with FTX and the impact that the rising rate environment has had on the tech sector broadly, but specifically on the cryptocurrency asset class. I am well aware that there are many, many other contributors, preconditions that contributed to these developments. And so I'm not trying to pin this entirely on rates, but with those preconditions in place, and in some cases, outright mismanagement by companies and entities, as rates increase, they become the precipitant for more challenging conditions. So Silicon Valley Bank, in a sense, was idiosyncratic. They were a very unique bank compared to a highly capitalized and very well-regulated U.S. banking system. They were an outlier of sorts in terms of their business concentration risk. They became a very large bank that was highly, highly dependent and built around a very niche business, heavily reliant on tech and VC and life science companies, which was a very non-traditional deposit base. They saw a surge in their deposits as those companies benefited, especially from the stimulus during COVID. And as those deposits soared, in the case of Silicon Valley Bank, they didn't necessarily do what most banks do, and that is engage in a significant lending business, right? You take in deposits and you create loans. In the case of Silicon Valley Bank, their client base, early stage tech startups, were not necessarily the best types of institutions for lending because they have very low fixed assets, highly volatile cash flows. They tend not to be the client base that banks lend to. And so what did Silicon Valley Bank do? They, of course, invested those deposits in a very large investment portfolio. And they moved pretty far out the curve on Treasury and mortgage-backed securities. And therefore, as rates rose, they found themselves exposed in recent weeks. So some of these institutions clearly had very idiosyncratic risk. FTX, very idiosyncratic risk. Silvergate, very idiosyncratic risk. But where they become more systemic, the thing that links them together is the idea that as rates rose significantly in a short period because they needed to, the financial system itself and many different types of institutions have shown themselves to be struggling with higher rates. And so my message to you today is, while we take comfort from the strong performance of markets yesterday and today, I strongly suspect that the calm that we are experiencing right now in the last 48 hours is not likely to continue smoothly throughout the year ahead. Theme number 2, financial stability concerns are certainly front and center. The way I think about it is, and having lived the 2008 financial crisis in this role, when you have a crisis of confidence in the banking system, it can be very challenging to restore it. And you do get these feedback loops that result in deposit and asset withdrawals. And we certainly saw that with Credit Suisse. Counterparties pulling back on banks, stock prices decline, CDS widens, and then you find yourself in a situation where there is a liquidity and funding crisis. And these things can move very, very quickly, even in cases where banks are extremely well capitalized on paper and the Fed is offering effectively whatever liquidity is needed. When the confidence is broken, the cycle begins and it accelerates. And that is where we have found ourselves in recent weeks. To take a step back, I would remind you, and this speaks to my point of a global financial system that is intolerant of higher rates. Every Fed tightening cycle of the last 40 years has claimed a major financial casualty, whether it be the LATAM crisis of the early 80s, the acceleration in bank failures in 1985, the S&L crisis by the late 80s, the Mexico peso crisis, the so-called tequila crisis in the mid 80s, the way in which the commodities supercycle busted in late 2015, early 2016, and almost took the global economy with it. The Fed is not responsible for these crises, and I don't want you to think that that is what I am saying. What I am trying to say is that when you have a dollar-based global financial system, and we do, and it is one in which the United States has certainly benefited from enormously, but when you have a dollar-based financial system, as we have had since the early 1970s in the global financial markets, when the Fed raises rates, should the preconditions exist, the Fed can become the precipitant, not the cause, but really the match that can accelerate a series of imbalances that may already pre-exist. And so we've actually been talking all year about this idea that as the Fed raises rates, where may the next accident be lying? And it took really a full year for that to play out, and it is part of what we are witnessing today. I'd like to emphasize that we do not believe this is 2008. I believe we have the most well-capitalized banking system in the United States and globally of our lifetime. It took a full crisis back in 08 to get there, but that is where we are today. But there is a fact pattern in the system of U.S. regional banks and other institutions where the rising rate environment can have an adverse impact on the financial system itself. Part of the backdrop here has been that during this decade of extraordinary easing by both the Fed and fiscal authorities, we had financial assets, stocks and bonds, financial assets grew for more than a decade at rates well beyond GDP growth. And so we arguably have an hyper financialized economy, both in the United States and in many places outside the United States. And in this case, against that backdrop of an outsized financial sector in many economies globally, the trigger event in this case became an accounting issue, the $620 billion of unrealized losses in the security portfolios of banks across the country. Back as recently as a little over a year ago, there were about $8 billion of unrealized losses across the banking system securities portfolios. But again, as the Fed began to rapidly increase rates over the last year, the fastest tightening cycle of the last 40 years, and that tightening cycle was warranted because of the move higher inflation in inflation. But as rates rose so significantly and the value of equities and bonds declined, last year, by the way, was the worst total return year in aggregate for bonds and stocks in 100 years. Let me just repeat that statement. Over the last 12 months, the aggregate return on stock and bond portfolios in US dollar markets were the worst in a century. And so, at least on paper, huge losses began to build in the U.S. banking system, in particular in the held to maturity bucket, which are not required to be marked to market on a daily basis. Post the financial crisis, the accounting rules were changed so that those securities would not have to be marked to market when you had significant fluctuations in capital markets for whatever reason. But of course, the challenge is, even though those securities don't need to be marked, when investors or depositors or private equity companies out in Silicon Valley begin to see that certain institutions have paper losses, not real mark-to-market losses, but paper losses, which are in excess of equity capital, they may choose to move their deposits out of that bank. And that is where we have found ourselves in terms of some of these deposit runs in recent weeks. Theme number 3, and I'm going to start to move a little bit more quickly through the 10 themes. One of the challenges before us is that the inflation problem, the inflation challenge we have, that the progress on that inflation is likely from here to be sticky and nonlinear. What do I mean by that? Well, you can see here in the yellow bars that over the last 6 to 9 months, goods inflation on goods, hard goods that we purchase, computers, automobiles, and other things that fall into the goods bucket. That inflation has come down dramatically, not just because the Fed is tightening, but also because consumers have shifted and normalized their behavior post-COVID slowly, but more quickly last year in the direction of more traditional services spending, more restaurants and travel and restoring hotel stays and stadiums and concerts and other experiences. As the consumer last year normalized their behavior back to more pre-COVID behavior, you can see here that goods prices have come down dramatically. The challenge is, if you look at the blue bars, is that services inflation has shown itself to not only be sticky, but it is still rising on the margins. And this is an economy that is 80% services. Inflation in aggregate peaked in June at 9%. Today, it's about 6%. We could quickly be down to 4%, but it's going to be really hard to get down to 2% in the year 2023, in part because, as we suggest, inflation in the services arena is likely to be sticky and nonlinear. And part of that, not all of it, is because the service sector has a sort of outsized dependence on labor markets, and wage inflation is remaining strong. Theme number 4, long and variable lags. Part of the challenge for the Fed and part of the challenge for markets is that it's very difficult to understand the impact of the tightening, even though the tightening cycle is largely complete, not entirely complete. And you can see here that the Fed's tightening cycle, the red dashed line on the right, has been the most rapid in 40 years, the most rapid in 40 years since the Volcker tightening in 1980. And by the way, it should be a rapid tightening cycle with inflation peaking above 9% as recently as June. That was only 7 months ago. But with the Fed tightening cycle almost complete at this point, the more important point is arguably that the impact of that tightening has really just begun. And that is in part because monetary policy operates with a lag of 12 to 18 months. This is an oversimplified schematic to show you the progression of impact as the Fed tightens. Initially, it hits markets in particular, and this is when the Fed started tightening a year ago. It hits rates markets and currencies and equities. It starts to hit tech valuations because so much of the PE multiple in a tech company's stock is inversely related to interest rates. Then it starts to hit the high yield market, which is an extremely important market in the United States. It is significant in its size. Telecom and media and energy companies and leisure and restaurants and other such sectors rely significantly on a very large multi-trillion high yield market for their financing. Well, issuance in that market last year was down 80%. And then the impact of this Fed tightening, while it sort of hits everything at the same time, but the preponderance of the impact begins to move increasingly from markets to the real economy and starts hitting the rate sensitive sectors like housing and auto, and eventually the C-suite of corporates that I speak to. M&A activity slows down, CapEx spending slows down, and that's exactly what's happening now. And as the year progresses, you'll begin to see more and more of an impact on labor markets and the consumer. And part of the challenge of that monetary policy lag is that as you tighten, it's very difficult to tell when and where the impact will take place. And so we find ourselves here in theme number 5, which is where Jay Powell and the Fed is today, the ambiguity of sufficiently restrictive. Is policy restrictive today? Should they have tightened 25 bips yesterday? Should they hold? These are very difficult questions to answer. Part of it is that data-dependent policy, as it should be data-dependent, does pose challenges. Part of the challenges that they are dealing with, number one, if you look at the upper left box, is that we have enormous fluctuations in the data. So the consumer, for example, consumer spending soared in January. And I think people incorrectly, and we put a lot of notes out in January, were way too comfortable with the fact that consumer spending growth soared in January. We were highlighting, which has shown itself to be the case, that consumer spending is actually, at the time, was down 4 of the 6 prior months. Really, now that we have the February data, we can see that the consumer spending has been down 5 out of 7 months, and that a lot of that surge in January was warm weather induced. Part of the challenge with focusing on data, of course, is also, as I've already suggested earlier, upper right, that some of this data is very sticky and nonlinear in its progression. We expect services inflation to come down this year, but it might come down, flatten, go up a little bit, then go down, go up a little bit, then go down. And a lot of data, especially if you look in the lower left, especially unemployment and labor market data, tends to be lagging indicators. Credit default rates in the credit market are lagging indicators. And some of the surveys that we use for JOLTS data and other economic data buckets have had very low participation rates for whatever reason in the surveys. So that does pose challenges for Fed policy and public policy in general. And so it's really difficult to sort of measure whether or not policy at this point is sufficiently restrictive. One thing I will say is that the Fed on the margins has probably been behind the curve for much of the year on inflation, but actually the market has been even behind the Fed all year. The market, more so than the Fed, has been the one that has underestimated inflation for a year and underestimated the Fed for a year. What we can see here is that the Fed funds rate today, after yesterday's hike, is still below the level of headline inflation. And to give you perspective on that, Volcker took Fed funds a full 5 points higher than inflation at its peak in the early 80s. And we are by no means suggesting that Powell should do the same. I think there's no question that our financial system couldn't handle it today. Today's modern financial system couldn't handle rates at those kind of levels. But we find ourselves in a situation today where the market now believes that the Fed will cut rates in the latter part of the year. We're actually in a situation where the market believes, as you can see by the dash line, that rates will be a full percentage point, a full 100 basis points below where the Fed is currently forecasting. I think the Fed is right to make clear that they are taking on inflation. I think, the lessons of history tell us that if you let inflation become embedded in an economy, it can be very difficult to get out. But the market believes that the recession is pretty much underway soon, and is taking a view that rate cuts are coming. What will be interesting is if we find ourselves in the second half of the year where economic data is clearly moving into recession territory, but inflation is still up in the 4% area, what the Fed will do in that environment. In my opinion, it is quite possible that the recession has already begun. We put out a note last week where we suggested question mark on the top of the page. Did the recession start on Friday, March 10th, the afternoon that Silicon Valley Bank went into receivership under the FDIC? I don't mean that question literally. What I'm trying to say, what I'm trying to suggest is that arguably financial market conditions and bank market conditions, which are both collectively responsible for the flow of credit in this U.S. economy, they have arguably tightened so much that the hard landing scenario, and we've been of this view since last July, is more likely than not. When you look at all the data across the U.S. economy, consumer data, business data, market data, and you examine where that data is trading today vis-a-vis where that data has been historically during times of recession, I sort of oversimplify it and give you a portrayal here of sort of red, yellow, and green light. Some of that data is flashing red, some of it's flashing yellow, some of it is flashing green, that there is still strength. But I would highlight to you that some of this data has historically been very reliable as a leading indicator for recession. And some of it, like a lot of the unemployment data at the bottom, which is still green, has historically tended to be a lagging indicator. One of the things that we know historically, and I could point to many different metrics, but this slide more than any other is why our team called a 2023 recession back in July. We called this recession 9 months ago because we looked at a U.S. economy where the consumer is 70% of GDP. And if you look how this U.S. economy behaves when inflation goes above 5%, historically going back to World War II, every time inflation goes above 5%, when the consumer is this larger percentage of the U.S. economy. The consumer is 70% of GDP in the United States. By the way, as a point of contrast, in China, the consumer is only 40% of GDP. When inflation rises above 5%, and we went well above 5% in the post-COVID period, when inflation goes above 5%, on every occasion, the U.S. economy has gone into recession. And when you then look forward to what has happened as rates have risen in the system and the pressure that regional banks are on, in part because of the position of their securities portfolios, and investor loss in confidence, depositor loss in confidence, rating agency loss in confidence, right? As we see that even smaller banks are under pressure, the concern that we have is even though the United States is largely a capital markets-based economy, and the capital markets are providing something like 75% of the credit flowing through the U.S. economy. But even though we are a capital markets-based economy, and by the way, as a point of contrast, Europe is more of a bank-based economy, and actually has a less well-diversified system of credit than we have here in the U.S. Nonetheless, it is true that the 4,706 FDIC-insured banks in the United States do play a very important role on credit intermediation, accounting for almost 50% of loans to the commercial, industrial, and consumer sectors, and as much as 80% to the commercial real estate market. And so as banks come under pressure and as markets come under pressure, you get a real squeeze in the economy that accelerates the probability of a hard landing. And you can see here on this page that history suggests when inflation goes this high and when the Fed is forced to tighten at the pace at which it is going, hard landing is almost always the result. There have been 12 Fed tightening cycles since the 1950s, and you can see here on this page that only 3 of them have been have resulted in soft landings, mid 1960s, mid 1980s, mid 1990s. It is very difficult to tighten policy in a manner, especially when the impact of that is 12 to 18 months, such that you bring inflation down, which you truly need and want to get out of the economy, but to do it in such a manner that you create a soft landing. And part of the challenge, of course, is a lot of the sources of inflation are coming from the supply side, right? Coming from the supply side. The impact of COVID, the fact that the consumer began, while they were locked at home, purchasing goods and shifting away from services, the dislocations we had in global supply chains, the sharp rise in energy prices in Europe and the United States in the 6 months following Russia-Ukraine invasion. So much of the source of inflation actually came from the supply side, and the tools that the Fed has to deal with that are on the demand side. And it's very difficult to align the two. So at this point, we sort of find ourselves in a situation with the stress of recent weeks that even as the Fed slows down, even as Powell said yesterday that they are near the end of the tightening cycle, the challenge for the economy is that banks and markets are now doing the tightening. You can see here this measure of financial conditions in the U.S. economy. This is really a proxy for lending, for bond issuance activity, for where credit spreads are trading, where interest rates are. You can see in the last few weeks that the system really tightened. We've had almost no issuance in the massive U.S. dollar investment grade bond markets, no issuance in the high yield markets, banks tightening the credit spigots. As bank stock prices go down in the current environment, and the United States has been hit harder than others, banks, of course, are dealing with net interest margin compression, tighter lending standards, and it is an environment where both the capital markets and the banking system are squeezing the economy. And so just as we are transitioning from Fed tightening to the market and banks tightening, we are also transitioning from a year in which inflation and duration risk is being handed off to a market that is focused on recession and credit risk. And you can see here that credit spreads are beginning to trade wider. Historically, investment grade spreads, which is the investment grade market in aggregate on the left side of this page, and this is the largest, most liquid corporate bond market in the world, where S&P 500 companies get the preponderance of their capital from. Spreads in that market have widened about 30 to 40 basis points over just the last 2 weeks. Historically, those spreads rise to about 250 basis points during times of recession. So we're not close to those levels yet, but you can get to those levels really, really quickly, and the high yield market moving sharply higher as well. History tells us that spreads rarely peak before a recession. Credit spreads and equity markets almost always test new wides in the case of spreads, and in the case of equities, almost always test new lows after the recession begins. What you see on this page is every U.S. recession since over the last 100 years, and you can see that on every single occasion, equity markets test new lows after the recession begins. And as I suggested just a moment ago, again, every recession over the last 100 years, there was only one occasion, 1945, where credit spreads actually hit their widest levels before the recession. Spreads almost always widen to their widest points after the recession begins, typically hitting the low point about halfway through the recession. And that's exactly where we're going. So that's the tightening in the financial conditions that we're likely to see. I know I'm a touch over the planned speaking time, but just give me 2 more minutes here before we go to Q&A. What I think is that, listen, we have probably, unfortunately, a very challenging year ahead. There is still good reason to believe that the recession may be mild. We are still optimistic that it will be mild, but that will ultimately depend on how significant the banking sector stress continues to be. But I think it's probably the case that a broader based, smooth, sustainable recovery is more likely in 2024. If you look at this page here, it's basically 95% of global GDP. And what you can see here is that almost every economy in the world is decelerating into 2023. That is arguably more important than whether or not we go into a mild recession or not. Only Russia and China have green arrows, and that's a little bit misleading. Russia's economy has been decimated by the war. It's just on a relative basis. It was worse last year than this year. And China has arguably already had its recession over the last 6 to 12 months during their period of zero COVID. But if you fast forward to what this chart looks like next year, in our opinion, almost every major economy in the world will be accelerating in 2024. These are consensus forecasts. I actually don't subscribe to the red arrow here for the United States. I think some of those forecasts are maybe a little bit stale and not fully accounting for the last few weeks. I think what actually happened is that economists on the street, and this is consensus GDP forecast, got maybe a little too optimistic in January and assumed that the timing of the U.S. recession was more likely in 24, which is why the U.S. has a red arrow. But I think it will become increasingly clear that that recession is likely to happen in 2023, and that we will, in fact, in the United States, have a green arrow in 2024, just as we're expecting in the rest of the global economy. And then lastly, on a longer term basis, which really speaks to our thesis on the new macro supercycle, this 40-year period that we have had since really the early 1980s, right? This 40-year period of really long business cycles, of interest rates coming down for 40 years, of inflation coming down for 40 years. We do believe that great moderation, that period we refer to as the great moderation, is likely over. We are expecting less monetary and fiscal easing over the next decade, certainly than we had in the decade after the financial crisis. We do believe that global supply chains are getting restructured globally. That may be a good thing from a security perspective, but it does introduce marginally more inflation. We believe that energy transition is a good thing, but it is also a modestly inflationary force, for certainly at least a multi-year, perhaps decade-plus period, and that we're likely in a new normal that probably looks like shorter economic cycles. Keep in mind that if you look at every U.S. economic cycle, as you see on this page, since 1850, and there's been 34 of them since 1850, the two longest were in the last 30 years, during that period of the Great Moderation. And we think that economic cycles in the new macro super cycle, the new normal of higher geopolitical risk, higher inflation, more term premium and rates, structured supply chains, energy transition, a lot of those things are good things. Some of them are less so. But in our view, they all contribute to what is likely to be a period of shorter economic cycles. It looks like this economic cycle will show itself to only have been 3.5 years long, to rates that are probably going to be a little bit higher than the decade before COVID, but not as high as the decade before the financial crisis. And we do believe that we are in the very beginning, perhaps year 3, of a multi-year, decade-long commodities supercycle. Within a commodity supercycle, you could have a year like this where energy prices actually go a little bit lower for 1 year, but generally are moving in an upward direction. And I'm talking about oil and natural gas. I'm talking about industrial metals that are critical to electric vehicles. I'm talking about agriculture prices that have been vulnerable to climate change and climate risk events, as happened much of last year, and geopolitical tension. There is a whole host of reasons why we think on a multi-year basis, commodity prices in the new macro super cycle are moving higher. So I will stop there and appreciate your patience. And I'll take any questions that you may have at this time. I'm sorry I went a little long.
No problem at all, Tom. That was excellent. Thank you so much for the presentation. I'm going to start off with the first question that I have here, and ask you to talk a little bit more about the parallels you see between the economic situation in the U.S. and other nations.
So I think there are multiple parallels. I mean, I can point to a lot of things, but the things that jump right out off the bat are sort of aging demographics, right, which lead to slower growth, higher debt levels globally, which also lead to slower growth and more volatility in markets. We've really moved past what we enjoyed in the 90s and 2000s as emerging markets led by China were really taking off, right? We've moved from a world that had excess production capacity and supply, right, to a world where that is more constrained, right? So I mentioned that I've been to 15, 20 countries over the last year. I think every single country I visited across much of Asia and Europe and here in North America has labor market shortages right now. Basically every country I visited except for India, right? So we've gone from a multi-decade period of excess production capacity to a new system where supply is more constrained. And by the way, even economies and economic systems and political systems that we may not have a lot in common with, such as China, such as Russia, we all have, in many Northern Hemisphere countries, aging demographic problems. Russia, China, Japan, South Korea, the United States, most of Europe, all have aging demographic challenges. And we all know that age 18 to 55, right? 18 to 55, that is the working force population in preponderance. We have recognized many people most people work past 55, but that is generally considered by economists to be the engine of any economy. And we know that workforce is shrinking. China's workforce arguably peaked in 2014 and has been coming down rapidly. So China has, for example, even though they have a very different system than ours, they have, for different reasons, a lot of similar problems. They have an aging demographic problem. They have a massive debt problem. They have a huge revenue problem. Hence the reason why China, for the first time in its modern history, is actually considering property taxes. So there are many reasons. There are many things that we have in common with other economies globally, including financial markets that have become very large. It's not because we've just allowed financial assets to explode. We have to remember that we've we've had this 20, 30-year period of extraordinary, and this is a good thing, extraordinary growth in the global economy, where many emerging market countries have gone from poverty to middle class. So we have this very large global middle class that is affluent and aging. And so we therefore have, arguably, I would say, over 200 trillion. Just think about that number. 200 trillion of financial assets globally, from people in the middle class across dozens and dozens of countries globally who are getting older, and they have savings, and they need to put that money to work in securities, financial assets that produce income, meaning global bonds. So this is part of how our financial economy, our global economy, has become so financialized. There are many reasons, but it's not just central bank printing. It's really this explosion of the global middle class. There is in the world, believe it or not, about 100 trillion plus of asset management money. There's over 40 trillion of global pension fund money. There's over 35 trillion of global insurance company money that is invested in securities, 11 trillion of sovereign wealth fund money, almost 10 trillion of money market funds. You add it all up and you have a very financialized global economy.
Okay, next question I have here. How do you see the Bipartisan Infrastructure Act, the CHIPS Act, and IRA impacting U.S. manufacturing growth, right? You talked about how, we've moved away from a manufacturing economy. We are much more focused on a service economy. Those three major pieces of legislation are trying to sort of turn the trend around on that. How do you actually see the impact on that? And you talked a little bit about this, but how do you think that those legislation are contributing to inflationary pressure with which the Fed continues to grapple with?
Well, let me just take the second question because it's easier. I think some of that stimulus is part of the inflation story, but I think thus far, most of the inflation that we've seen over the last year, very little of it has come from those three pieces of legislation. The vast majority of that money has not been put to work. The vast majority of inflation has really come from the sort of COVID era stimulus, number one. Number two, perhaps more than anything, the most important driver really should be point number one, is the way in which the consumer, by the way, sitting at home, I'm exaggerating to make a point, but being home for a year or two and not spending on stadiums and concerts and restaurants and travel, right? All of that spending was saved. And the US consumer arguably saved in excess of normal savings over 3 trillion. They have since spent about half of that savings. So that excess savings is down to about 1.6 trillion. But so much of the inflation has actually come from COVID-induced consumer savings because people weren't out there spending on all of those experiences. So I think a low percentage of it, of the inflation that we have today, and then, of course, all the supply chain bottlenecks, right, as everybody goes out and buys goods, you get back up in the global supply chains, and some of the COVID and China's zero lockdown created the bottlenecks in ports, right? Inflation was coming from places that were largely unrelated to those three bills. Now, will those three bills drive a reindustrialization of America? I mean, I think, let me just say it's too early to tell. In some areas, right, where government tax policy and spending is encouraging spending to go, may not be the place where spending needs to go. I think in many cases it is, and in many cases it's unclear. But just to size some of this, like let's just take the CHIPS Act. That's 50 billion of subsidies per year, 50 per year. Well, to recreate the semiconductor supply chain domestically, some of the consulting firms will tell you you need about 1.5 trillion up front, 1.5 trillion up front, and arguably 250 billion of annual capex maintenance spending. even if those numbers are off 10 to 20%, you can see here that we are not going to be recreating the semiconductor supply chain domestically in the United States anytime soon. What I think we are doing, which I think is a good idea, is trying to move at least some portion of the really high-end production for security reasons back to the United States, though it is not clear that the plants being built are going to be producing the highest end chips. We have globally a semiconductor supply chain that is globally extended and regionally concentrated. So almost all of the most important part of the supply chain is in fact still done in the United States and Europe. We do almost all of the design, but we have outsourced the sort of fabless manufacturing model, the manufacturing, where 70% of that is done in Taiwan, Japan, and South Korea. And if you're talking about really sophisticated chips, 3 and 4 nanometers and below, it's 100% market share in Taiwan. And then the really low end part of the process, the assembly and packaging and testing, a lot of that is happening in China, Malaysia, and Southeast Asia. So it's going to be very, very difficult to recreate the entire supply chain in the United States or any country. In my opinion, it's a pipe dream. I think what would be smart, which is what we have underway, is to bring at least some larger portion of the manufacturing step back. But the money that requires and the public-private partnership to do that quickly is going to be very, very difficult to execute.
Thanks, Tom. I see that we are just about out of time. I'm going to just ask one more question. What do you mean by supercycle? Is that a technical term or is it just good marketing?
No, I think what we mean is, I don't know that it's marketing. I don't know that it's either marketing or a technical term. I think it's just a term that has been commonly adopted in the market to refer to this sort of fundamentally new and different looking period that we think is just going to look very different from prior economic and market cycles.
Okay, well, with that, we are just about out of time. Tom, I want to thank you so much for all of your insights. We'll be sharing the recording of this session. We'll be sharing it out. So if anyone didn't take notes fast enough, we'll be sending it out. And obviously, Tom's slide deck will be within that video if you missed anything there. Tom, it was great having you as part of our Economic Advisory Council. And everyone who's joined us, thank you so much for spending a bit of your morning with us. And we'll see you next quarter.
Thank you so much. It's a pleasure being here. Thank you.
Bye-bye.